Will the presidential election affect the stock market? That is the question we answer in this episode.
To learn more about how to secure your retirement and all the different elements you need to know, please subscribe to our channel and hit the bell so you'll be notified when we release episodes every Monday. We have helped hundreds of our clients gain clarity and get on the path to a great retirement. Now it's your turn. Let's dive in.
Welcome to Secure Your Retirement Podcast. Today, we're going to be talking about a topic that everybody's going to be talking about for the entire year. And the question is, does the presidential election affect the stock market? And a lot of people are concerned about that. And by the way, Merce and I in this podcast are agnostic. This has nothing to do with whether it be any particular party that gets elected. The question is, does a party, different party, whether it be a change of a party or whether it be a philosophy or a thought process, is how does it affect the market? And this concerns a lot of people because right now, if you look around, obviously it's not anything that we have to hide. The United States is basically split almost evenly down the middle in the context of like, well, if this happens, this is going to cause a problem. And if this happens, or the opposite of what that is being said, is that going to cause a problem? And so we kind of want to talk about that to give perspective, but also how do we put together a plan that helps us have peace of mind? Because that's a real big focus of what we do here. So I'll let you kind of start off, Merce, and let's talk about really, the effects in the short term of what can happen when it comes to this idea of a presidential election.
Yeah, I was at a wealth management conference and we heard a bunch of economists speaking and some larger people with Charles Schwab speaking. And the question always comes up in an election year, what's going to happen to the markets given being in an election year? And the answer was, in the short term, you are going to have volatility. You're going to have it because there's a lot of uncertainty. There's a lot of speculation around, well, if this person gets in, what are their policies and how is that going to impact? And let's align the portfolios this way. And if this person gets in, it's vice versa, right? There's also headlines that are all over the place every single day that are going to impact the market to a degree. And so we always tell people to turn off the news to a degree, right? Because you are going to have things that come about. There's going to be breaking news stories and everything like that that's going to make some investors react to that, and that's where you have increased volatility. But if you look at it from a longer term type of perspective, way back to the 1900s, overall, does the election have an impact on the stock market? Not necessarily. But in the short term, you will see some higher volatility, mainly because people are nervous. People are concerned about the outcome and where the world and the U.S. is going to go forward. And so they are nervous about that election year, and that's where you will see heightened volatility.
All right, so that's in the short term. Short term, going to have some volatility, probably no matter what, just because, especially before the election is known, and then if you go through a scenario where there's a battle even after the election of like who actually is the president, that's going to cause some uncertainty. Obviously, the markets don't like that in the short term. Long term, if we go all the way back to the year 1900, long term, a party change is not what's going to affect the market. You can look at any kind of scenario you want to look at. We've had up markets and down markets across the board, regardless of who is in the office of the president. So that is not going to really be our concern. And so if we wanted to kind of sum this up, yeah, there's going to probably be a little bit of volatility in 2024, but not anything that's going to be because of one thing or the other. So the question is, what can we do? How can we have a portfolio that's really kind of there, and it really is itself agnostic in the sense of what's happening, who's elected, what's happening in the economy. And what I mean by that is, it is able to be nimble and it's able to deal with different aspects of the market. Now, what I'm going to do is kind of lay out to you the models that we use. And I want to say this, if you're listening and you're not a client of ours, that's okay. We're not trying to say that this is the perfect portfolio. We're not trying to say it is the best way to go no matter what. But if you think about the name of our firm is Peace of Mind Wealth Management, we do this podcast called Secure Your Retirement. Our philosophy, our mindset is all about risk reduction. So we're just going to describe to you a way to do something, and then you can kind of do with that what you want. And we'll even draw some comparisons. And again, this is not to beat down one and say that the other is right. But if you were to go out and talk to 100 financial planners or financial advisors, you would find that there's really two big camps when it comes to how to manage a portfolio. One is a passive buy and hold portfolio. What that is that's where I'm going to take my risk tolerance and I'm going to build a portfolio, and I'm going to hold that portfolio with some rebalances occurring either monthly or quarterly. And that I'm just going to stay there until my risk tolerance changes. And it doesn't matter what's happening in the market. It's not going to affect it. The other camp is what we call active management. An active manager is basically trying to say, I want to adjust my portfolio regularly to deal with risk. Now, there's a couple different ways to do that, but ultimately it is making adjustments in the portfolio, either making a move as the markets change, basically trying to stay current with the markets. And you could have both of those camps argue against the other. And so our portfolio, if you take our growth portfolio, it really takes a little bit of both of those mindsets and puts them together. So Merce, if you can kind of talk about, and we'll talk about our growth portfolio because it's the one that's kind of taking those two camps and saying, let's not try to figure out which one's going to do better. Let's take those two camps and combine them and marry them together.
Yeah. So our growth portfolio, if you picture, say you have an account and you split that account in half, that's essentially what we're doing. And those two halves have a theme to them. The first theme on the first half of the money is going to be what we call strategic core. And then the second theme of how we're going to invest that money is called our tactical. And Radon was saying, passive versus active, let's marry these two together. So our strategic core model within the growth model, you have to envision one account that's got some themes within it, right? And in the strategic core portion of the account, it is equity based. So we are buying, in our case, we're buying exchange traded funds, ETFs, but they're pretty much operating like stocks do, a bucket of stocks in all essence. And so in our strategic core, the theme is that we are fundamentally approaching the stock market. Fundamentals mean, where do we think the market is going based off of some relevant information, not for the super long term, but the near to mid long term, intermediate to, couple years out type of perspective. If you go back into, I don't know, 2021, 2022, the big thing that was on the table was, hey, we're going to go into a recession. It's on its way. It's on its way. And we keep saying that now. That talk has gone down quite a bit as we are in now 2024. And now the question is, are we going to hit this recession, or is there no landing whatsoever? But that's what fundamental talk is. Let's align the portfolio to what we think is going to happen based off of the economic conditions. Right. And so that's what we do for a portion of the money, because we believe we're not completely smarter than the stock market. So we should have a portion of the money that is forward looking. That's also always invested at all times. And so today, the way that portfolio sits going from 2023 going into this year, it's a little bit on the side of, well, if we do have the recession, these assets will do better than most. So a little bit more value driven. I will tell you that sentiment is changing, and that's part of being involved in somewhat of an active strategy overall, is that we are going to make a shift in some time here when we get confirmation around this recession and where rates go and what the Fed does, all these different things that play into fundamental analysis. But for today, that side of the portfolio is rather geared towards, what if we do have this recession that's been talked about for so long now? The other side of the portfolio in that account is going to be our tactical side. Really, what I call this is our risk management tool. right? Our strategic core always invested forward looking. Our tactical side is invested, but it is also saying, instead of being forward looking, let's say what's working right this moment, right? If you go, look at over the last 18 months, the things that have been working very, very well has been large cap growth companies, technology, anything AI driven, semiconductors, things like that, right? And so the portfolio on that part of that theme, if you will, has been aligned a little bit in that direction. That way, if the fundamentals are a little bit off, well, what's working right now is going to, help or be a good complement to that, and vice versa. So that tactical side is a little bit more active, not day trading by any means, maybe on this realm of maybe making a trade, once a month or something like that, every 4 to 6 weeks. We're seeing trends change and we're going to adapt with the trends changing. So a little bit more active there. I'll go back to what I said. We use the tactical piece as our risk manager, right? So go with when I ask the question of what's working right this moment, the answer is technology and large cap. If you go into 2022 and you ask that question, what's working right this moment? A lot of assets were falling for the entire year of 2022. And so for that reason, there was a periods of time in 2022 where our tactical was not invested in equities. It was actually invested in lower risk assets like government treasuries, which are paying a decent yield there to not to make money, but they're there to reduce volatility of the portfolio. So that's why I can say it is a good risk management tool. So if the market's working great, all lights are green, it's invested wherever the best place to be is at the time. If the market's not working so great, or we've got declining or deterioration in the market, then we can pull this back and put the brakes on this side of the portfolio. So those are the two themes in our growth model: equity based, we've got core, which is fundamental based, and then tactical, which is what's working right this moment.
Okay, so now what we do is that, okay, that's one aspect, but then we'll have some folks that'll come in and they'll go, okay, well, I want to have a part of the portfolio that's really stable. And a lot of times people start looking at what's called fixed income type things, and they'll like look at things like bonds and those kinds of instruments. What we did is we said, okay, if we got this growth portfolio and we just want to have a layer of something that goes into it that kind of gives us some stability, that takes us to what we call our moderate growth portfolio. And there, what we do is we introduce to it a piece of the pie that are what are called structured banknotes. So the way we do that is 24% of the portfolio is now going to move toward these structured banknotes. In the structured banknotes, we're going out to the market. So we're going to talk into large banks like Morgan Stanley, Citibank, Barclays, just to make a few, talk about a few, and we are able to structure an instrument that's going to give us in all essence, coupon rate based on an annual percentage. And those percentages of return, those interest coupons, can be really attractive. As we are recording this particular podcast right now in March of 2024, those coupons are around 9% annualized. So what that does is that now takes a part of the portfolio that lowers the risk even more on that portfolio so that the client has some fixed income coming in on that. Now you have your other parts, which are your core and your tactical, as Murs talked about. Now, if a person's even more conservative, we then can start adding to that portfolio some traditional fixed income type investments to take even the risk down further. So I just want you to understand that the idea here, imagine you've got a portfolio that one is saying, hey, we don't know what's going to happen in the market, so let's be invested with some really smart fundamentals. Let's take a part of the portfolio and let's be tactical and say what's really happening, boots on the ground right now, meaning something happens that's bad, the risk could get high, we can lower that risk on a quick type time frame. And then you got this other part of the portfolio that says, hey, let's just get some stability and have it in there. I am now way low on the totem pole, worried about what's going to happen in the world. I mean, I'm worried, right? I'm worried for other reasons than even money sometimes. But from when it comes to my retirement plan, I have that security. I have that peace of mind. I can go to sleep. I can wake up, and I'm not worried that if this thing happens today, that I don't have something already in place and I'm not calling up my advisor and my advisor saying, don't worry, hang in there. And a lot of people don't like that approach. They want to know that there's something that's there, that's predetermined, predefined, and ready to go. Anything else on that, Merce?
No, I think that's the gist of how we operate as far as managing money. A lot of times you hear the story or the phrase being said of make sure you don't put all your eggs in one basket. Well, or in our case, what we believe is let's not put all our eggs in one particular type of strategy. Let's not just be all fundamentally focused, buy and hold and let it ride. Let's not all be tactical either, and let's just try to play the market and try to beat the market, because we don't believe that's very doable. It can be done from time to time, but it's difficult. So we say, let's take a combination of tried and true strategies and put them together so that if one isn't working all that great, the other ones are there to, prop them up. And so it works very well.
All right. If you have any questions about anything you ever hear on the podcast, on today's topic, a previous topic, feel free to go to our website, top right-hand corner, click on schedule call. That will bring up the calendar of Merce and myself, and you can just schedule a visit with us. We're glad to sit with you on the phone and talk this through, answer any questions that you have whatsoever. And if you also want to read about it, you can go to our blog page. We have a whole blog article written on this very topic as well. We hope you have a great week. We'll talk to you again next Monday.
We hope this video has given you some confidence and clarity as you plan for a worry-free life in retirement. But what else do you need? We have created a complimentary video course called 3 Keys to Secure Your Retirement. This video walks you through step-by-step what you need to do to get ready for retirement. You can also check out our podcast called Secure Your Retirement. You can subscribe below.
For more retirement tips, check out these videos. Also, if you find them valuable, please subscribe to our YouTube channel and give us a like.